Welcome everyone. Today's presentation it will be on smart ways to give to charity. We're very pleased to have you here. I'm confident you'll benefit from the information we provide you today. But first, let's get some of the disclaimers out of the way. This discussion is not meant as a one-size-fits-all investment advice or recommendation. Therefore, we highly recommend that you speak to your financial advisor, tax professional, or attorney for information on your specific situation. My name is Deb Klein, and I've been a financial planner at Azad Asset Management for almost 4 years. I attained my Certified Financial Planner designation 3 years ago. For over 25 years, Azad has been helping high-income professionals build their wealth in accordance with Islamic values. Today, we manage over $1.2 billion for more than 1,000 families across the United States. What makes Azad unlike many other financial firms is the quality and nature of our advice. It's centered around you and your family and driven by a higher purpose and designed to help give you peace of mind knowing your financial life is on track. We help clients implement our advice using more than a dozen professionally managed investment portfolios. We make consolidating your investments under one roof easy by covering a variety of asset classes, including halal fixed income, international, small, mid, large cap U.S. stocks, real estate, and even a dividend income strategy. Our investment track record spans more than 2 decades, with those of our institutional money managers spanning even longer than that. We like to consider ourselves your family's chief financial officer. We believe financial freedom comes from knowing you're maximizing all your planning options. Our process starts by getting to know you, your needs, what matters most to you, and your risk appetite. Then we help you focus on matters that you can control and where we can make the greatest impact, like tax management, charitable and estate planning, and investment risk. We'll organize everything for you in a financial plan so that you can track and measure your progress every year. No matter what stage of your financial journey you're on, we can help give you financial clarity. And it's not on the slide, but one of our most important jobs is acting as a behavioral financial coach. During hard times, just sticking to an investment plan, regardless of how well designed it may be, can be challenging. We help our clients make better choices and stick to their plans by coaching them through difficult times. Here are some of the awards Azad has recently received. This includes being named to the CNBC Financial Advisor 100 list and the Financial Advisor Magazine RIA ranking list. Our investment strategies have also earned awards and received PSN Top Guns awards. Visit our website for more information on these recognitions, including the criteria required to receive them. But of course, we owe our greatest gratitude to the hundreds of clients who have entrusted us with their dreams and aspirations. Okay, now we're on to the program. And here's a look at the agenda. We'll be looking at giving through assets, planned gifts, and charitable lead trusts. Let's turn first to the charitable giving through an IRA. Understanding qualified charitable deductions begins with understanding required minimum distributions, or RMDs. At age 73, people with IRAs are required to take a distribution from them each year, even if they don't want or need those funds. That distribution increases their total taxable income. And that additional income could potentially push them into higher income tax bracket. It can also trigger phase-outs which limit or eliminate some of the kinds of tax deductions, such as the personal exemption or itemized deductions, and sometimes trigger higher taxes on Social Security income or higher Medicare premiums. The qualified charitable deduction is a direct transfer of funds to the charity. It is never in the IRA holder's possession. Instead, the IRA custodian, either the Fidelity, Schwab, etc., either sends a check directly to the charity or sends a check made payable to the charity to the account owner, who then hands it over to the charity. The charities must be qualified 50c3 organizations. Many mosques, nonprofit charities, educational organizations, and nonprofit hospitals are qualified. An individual donor can contribute up to $100,000 per year in QCDs, and a married couple can contribute up to $200,000. A donor can make one large contribution or several smaller contributions over the course of the calendar year. An important distinction to note is that by never taking possession of the distributed funds, you can possibly receive more in tax savings. In this example, there is a $100,000 RMD that must be taken. In option 1, the person took the distribution directly and it was transferred to their bank. They then calculated that they would need to put aside $37,000 to cover the additional taxes on that money. This left them with $63,000 to donate to charity. And that $63,000 charitable deduction saved them approximately $23,000 in taxes. But if they had instructed their IRA custodian to make the QCD directly to the charity, their income would not have increased and they would not have had to pay any additional taxes, thus saving them $37,000. So rather than withdrawing your RMD and donating the proceeds, a tax-smart way of benefiting both you and your charity is to pass that RMD along directly to the charity. Now let's turn to giving through appreciated securities. Appreciated securities are securities that have increased in value. If those securities are in a taxable account, you pay capital gains taxes on the increased value when you sell them. Here's an example scenario to help explain the process. You bought stocks 10 years ago for $15,000 and they're now worth $50,000. A person with appreciated stock in their account has two options. Option 1, they sell the stock and donate the proceeds to a charity, or option 2, they donate the stock directly to the charity. Here's how those scenarios turn out. Option 1, you sell the stock, you pay capital gains on $35,000, which comes to $8,330. Then you give the remaining amount to the charity. Your personal income tax savings would be $15,415. Option 2, you donate the stock directly to the charity. The charity receives $50,000 and you have a $50,000 charitable deduction, which saves you $18,500. You're also saving the $8,330 you didn't pay on capital gains tax, so your total tax savings is $26,830. Again, this is the same concept we saw when donating directly from the IRA. What are the advantages of gifting through appreciated securities, either individual stocks or mutual funds? Well, you avoid paying capital gains, you get a deduction on the full market value of your securities, and the charity receives securities which could continue to appreciate. Now let's turn to donor-advised funds. A donor-advised fund is a separately identified fund or account that is maintained and operated by a Section 501c3 organization, which is called a sponsoring organization or an administrator. The donor-advised funds allows donors to make charitable contribution, receive an immediate tax deduction, and then recommend grants from the fund over time. Donors can contribute to the fund as frequently as they like and then recommend grants to their favorite charitable organizations whenever it makes sense for them. A DAF, or donor advised fund, is like having your own private foundation, but it requires less money, time, legal assistance, and administration to keep and maintain. A donor advised fund also enjoys greater tax advantages than a private foundation. You can claim a tax deduction in the year you contribute assets to the donor advised fund, rather than in the year the contribution goes to the charity. For example, if you typically donate $3,000 a month to charity, $36,000 a year, you could essentially prepay 5 years worth of donations by putting $180,000 in a donor advised fund. The donor advised fund would use the money to disperse $3,000 a month to the charity as usual, but you would get a $180,000 tax deduction this year instead of a $36,000 deduction every year for the next 5 years. Getting a giant deduction in 1 year could be worth more than a smaller $36,000 annual deduction. I'll give an example of this in a later slide. You do not pay capital gains on assets you put in the donor advised fund, and this is a great opportunity to give appreciated securities. The donor advised fund grows tax-free until you're ready to donate to the donor charity of your choice. When estate planning, you can make a bequest in your will so that any remaining assets in your donor advised fund are donated to your charities of choice after you die. There's also the option to pass the fund to heirs so that they can take the philanthropy mantle and give grants to the charities that they want to support. Some individuals gravitate towards the donor advised funds because you can choose to withhold your identity and gift grants anonymously if you don't want to be solicited for future donations or don't want your donations to become public knowledge. Moving on to planned gifts. A planned gift is a contribution that is arranged in the present and allocated at a future date. Commonly donated through a will or trust, planned gifts are most often granted once the donor has passed away. Some planned gifts are payable upon the donor's death, such as a life insurance policy where the beneficiary is a charitable organization. Charitable remainder trusts provide an income stream for individuals, and at the death of the donor, the charity receives what is left in the trust. On the other hand, a charitable lead trust produces a stream of funds for a charity, and at the death of the donor's heirs receive what remains in the trust. Now let's turn to charitable lead trusts. Let's assume the hypothetical scenario on the screen. You're in a high tax bracket and want to take the most deductions possible this year. Maybe you sold a business or a piece of property. You have $500,000 you want to commit to public charities, but you also have longer-term expenditures on the horizon. A charitable lead trust may work for you. First, a charitable lead trust is established with the help of an attorney. A trust is an entity in which the property is legally held and managed for a set period of time. You decide how long the trust will last, who will manage the trust, and how much will be paid out to charity each year. You then fund the trust with contributions of cash or other assets such as appreciated stocks this year and take that big deduction. During the term of the trust, a specified percentage is distributed to the charity of your choice each year. At the end of the trust term, typically 10 years, the balance returns to you or your family. The beauty of this technique is that it can still offer tax advantages while giving you more control over your money. Many of you may be thinking that establishing a charitable lead trust must be complicated and expensive. However, by completing a few simple steps, Azad can help you establish this solution for yourself. A competent legal advisor is needed to draft the trust. Azad will help you in guiding the process between you and your attorney. You also need to pick a trustee, administrator who will oversee managing the trust. Each year, the trust will need to file Form 5227 as a split interest trust return. You'll also need to pick a non-charitable beneficiary like your grandchildren. You will then need to decide the percentage of trust assets per year that you're giving to charity and how many years the trust will last. At the end of the life of the trust, all the remaining trust assets will pass to the non-charitable beneficiary. Landscape changed substantially in 2018 as the Tax Cut and Jobs Act nearly doubled the standard deduction, but capped the state and local tax deduction at $10,000 and eliminated miscellaneous 2% itemized deductions. Due to the new changes, taxpayers should evaluate whether charitable giving strategy would produce a tax benefit. Taxpayers may benefit from accelerating or bunching charitable gifts to maximize itemized deductions in a single year while taking standard deduction in other years. In the level giving example, the couple's itemized deductions before charitable gifts total $19,000. That's the mortgage interest and the state and local tax. Since they're married filed jointly, standard deduction is $27,700. They'll take the itemized $49,000 deduction each year, which seems like a win. In the bunched giving scenario, the couple accelerates the charitable giving into a single year, giving $120,000 in the first year and no donations in year 2 through 4. This gives them an itemized deduction in year 1 of $139,000. In years 2 through 4, they take the standard deduction of $27,700. If you'll notice, the composition of itemized deductions is the same under both scenarios of a 4-year total of $196,000, yet bunched giving produces a greater cumulative tax deduction of $26,100 over the 4-year period. Today's presentation or would like to discuss any of the strategies you've learned about today, give us a call. For more information and timely updates, please follow us on social media and visit us at azadasset.com. I hope you enjoyed today's presentation. Thanks again.